Welcome to this webinar on seed funding, how you can raise the seed funding you need without angels and VCs. My name is Michael Scott. Yes, just like the lead character on the TV series if you watched it, but I'm the original and much smarter. And I'm going to be your host today. We're going to be talking about all forms of seed funding, including angels and VCs, but most of this content is focused on other sources for early seed funding, particularly the first $1 million to $3 million or so. Now, this will be particularly helpful if you're not located in Northern California, New York, Austin, or anywhere else that doesn't have professional angel investors and venture capital. Today's webinar is divided into 3 parts. The first is I'm going to review common mistakes most people make raising seed funding that is keeping you from closing the money that you need. Next, I'll go over 5 powerful components that you should have in your seed funding strategy in order to find and close more money. And lastly, I'll be reviewing what you must accomplish with the seed money you raise if you want a chance to go all the way. Now, understand, my results are not typical. Yours are going to vary from mine. That's just common sense. What I am going to be sharing with you is what's worked very well for me and others who have raised a significant amount of seed money. What you do with this information is entirely up to you. As a founder and CEO trying to raise more seed funding, you can't be immune to the headlines about layoffs, VCs no longer funding, recession, you name it. So the first thing I'll advise you is to ignore the headlines. Don't read them. Go to extremes to avoid them always. You don't want that noise in your head when you're raising money. And I'm going to show you how to raise funding in the toughest of climates, like right now. So where are you? A little anxious about money, I'm guessing. Be assured you are not alone. Though what I'm about to share with you is not magic, this is not going to show you the one thing that will instantly make money appear. Raising seed funding is not easy because it's the highest risk funding any company will raise. Funding a company is like climbing a staircase of risk and value. The higher you climb, the less risk there is for investors and the more your company increases in value. You only get to take the next step up after you have removed some risk for future investors. The essence of funding in early stage companies is all about staying alive long enough to be successful. Prove your business model, then scale your business and make it profitable. But until you do all that, it's all about survival. Right now, things might be taking longer than you expected. Maybe you're not really clear about what to do next. What you do know is something needs to happen quickly. That's why you're here, to get ideas for how to move forward. Perhaps you already hit up all your siblings, parents, aunts and uncles, maybe even your grandparents. You sure don't want to lose their money. But doors might be getting slammed in your face today. You believe in what you're building and are positive it will be successful. Why can't others see that? Now, if you can relate to this statement, that's okay. That's also why you're watching this webinar, so you can get unstuck. Now, there is no silver bullet to raising seed funding, but there are 5 proven elements in raising seed money that will get you results and on your way to surviving long enough to be successful. So why should you listen to me and what I have to share with you today? As I said, my name is Michael Scott, and I've raised more than $119 million over the last 25 years. Much of it was seed funding to build startup companies, 7 of which were my own in software, technology, and service markets. I also helped raise early money for another startup that has since taken off and will soon IPO. So I've learned a few things along the way that can help you. Some of what we've learned through all these companies is that you have to talk to someone who has done it before, have someone experienced to bounce ideas off of, they can let you know the next 3 steps in advance and be able to share your concerns and problems with someone who has been there before. So why are we doing this? Well, there are really 2 reasons. The first is realizing this is a really difficult funding climate. And we know by sharing what has taken us decades to learn, we can help companies that have raised at least $25,000, but less than that, $3 million, through the most difficult part of company building and fundraising. The second reason is to also identify founders and companies who may be possible candidates for mentoring and or a seed accelerator. We're in the early stages of developing. Okay, time to make a decision. Continue doing things the way that you have, or keep watching and find out what Chris and I spend decades learning. Let's begin by defining what we mean when we say seed funding. Now, there are no established limits for seed funding, but for the purpose of our discussion today, we're talking about the first $25,000 up to $3 million or so of resources raised by a company for its early stage development. Seed funding can easily run to $5 million or even $10 million or more for some companies, and for others, they will raise their Series A round after their first $2 to $3 million. The primary parties that typically invest at the seed stage in order are the founder or founders, family and friends of the founders, and then there are what we call MLE investors. MLE is our acronym for Money Limited Experience, as well as seed accelerators, and finally, professional angel investors and venture capital. The first rule of seed funding is don't leave money on the table. And all these groups represent potential sources of seed investments that we're going to review right now. Here are the average ranges of the different investor types: founders, family, friends, accelerators, MLEs, and of course, angels and VCs. Now, every investment event for every company will be different, and so will the investment ranges and investor groups. So none of these are hard and fast limits. This is just to give you an idea. We start with the founders. Now, it's critical to understand people who write those early checks do so because they believe in the founders and see them as trustworthy. It's a 90+% emotional decision because there's little, if any, actual proof or evidence in the early days that the product or service can be built and successfully deployed in the market. Investors must believe in and trust the founder or founders. How much have you, the founder, personally invested? That's the first thing most investors will be asking. Sweat equity doesn't count. Founder capital can be in any form of cash, bank or product financing, or contractual commitment that results in cash proceeds or resources for an early stage company. And that includes development work and prototyping by third parties. Next, it's time for family and friends, which includes anyone who knows you. They don't have to be a good friend. Family and friends are crucial in the funding of a company's early days because they know you and believe in you. The reason it's so important to get family and friends to invest is what it says to other investors. If the people who know you the best aren't willing to invest in you, why should someone who doesn't know you take that bet? Now, MLE is our acronym for people with money but limited experience investing. MLE investors are often successful professionals like doctors, lawyers, engineers, and others who make a good income, some of which is disposable. And when it comes to seed funding, MLEs are the richest source of seed money for early stage companies, particularly your first $1 million. MLE investors will often write bigger checks than friends and family, which is terrific. And they almost always have other people in their network like them who also have money or income to spare, bringing other new, often larger investors to your party. Next are seed accelerators or startups accelerators. Accelerators are organizations that support seed and early stage startups through a formal, defined mentoring program from experts with experience across the startup spectrum. Programs typically last from 3 to 6 months and culminate in a demo day, where graduates showcase their businesses to investors, press, and potential customers. Membership is by application, and many accelerators specialize by vertical, geography, or type of company accepted. Accelerators invest early money in the companies they accept, but primarily are providing needed expertise to the founders. In exchange, an accelerator's investors receive equity, usually 7% or so. And finally, there are angel investors and venture capitalists who invest professionally, full or part-time, in risky early-stage companies in exchange for stock. They generally will not participate in a company's first $250,000 to $500,000 in funding, though there are a few that focus on pre-seed and seed investments that will invest after the first $100,000 or so, depending on the people and product. Angels and VCs often make the largest investments in a company's seed funding, but it's not always necessary to turn to them. Angels and VCs look at thousands of deals each year and invest in only a handful, making them a low percentage play for the funding you need. First and foremost, angels and VC investors are looking for proof of the business, product, and people, as well as evidence of a potentially huge opportunity. If you don't have proof yet, you shouldn't be approaching professional angels or VC investors until you do. Angel investors also have their own network and often invest alongside with people they know, as do venture capitalists. There are also angel groups made up of individual angel investors who meet regularly to socialize and review prospective investments. And today, thanks to changes in security laws over the last several years, particularly Reg CF or regulation crowdfunding, the ability to market your offering to thousands of potential investors is available through more than 60 different early-stage funding websites. But you have to be well along in your product and company development before even considering this route. Now, before we go further, I want to again reiterate what I'm about to go through is not magic. Raising seed funding is not easy because it's the highest risk funding any company will raise. You must be committed to getting this done and be willing to stick to it. This webinar won't help you, start a company or come up with an idea for a company. You need to have already raised at least $25,000. You need to be able to drive your company through brick walls to get to the money that you need. You've already started product development, and nothing is going to stop you from being successful. The best way I can help you today is by sharing 3 proven strategies for raising seed funding. The first is to stop making some of the most common mistakes, so I'm going to be touching on what they are. Next, I'll go through the 5 components that you should have in your seed funding strategy to maximize your success. And lastly, I'll review some things you should be focused on accomplishing with the seed money you raise if you want a chance to go all the way. Now let's start with some of the most common mistakes in raising seed funding that you should avoid. Now everyone's circumstances are different, but just know if you keep making these mistakes, they are making it really difficult to raise the money that you need. Number 1, if you are early in raising seed funding, like your first $1 million, 25 to 50% of your time as CEO will likely be spent raising money most weeks, or you'll run out of money. You can't wait until you need it to start talking to prospective investors. Number 2, wrong or low percentage investor targets will waste your time, discourage you, and can kill your entire fundraising efforts. We're going to go over who some of the low percentage investor people are in a few moments, as well as who are the right investor targets. Number 3, entrepreneurs can be lulled into putting all their eggs in one basket and with fingers crossed, hoping that one investor will come through while largely stopping the pursuit of other potential candidates. This is deadly on multiple levels for obvious reasons. Number 4, you can never use new investor money to pay off debts, especially to earlier sources of money. If that's in your plan, take it out. No new investor is going to let their money pay off a previous investor or money source. Everybody needs to be sharing the risk. If you have prior debts, settle them with stock and get them off your balance sheet that way. Number 5, you have to be clear on how much to raise now and for what. Remember, raising money is like climbing stairs. You must take risk off the table for your investors with each new round of funding to take the next step up. And that determines how much to raise now. Number 6, never get in front of angels or VCs before you're ready. Angels and VCs are professionals who don't play in the first money or early money realm of funding before there is proof. That's what you use your family, friends, and MLE investor money for. Number 7, you can't afford to burn up good leads. Actual investor prospects that really do write checks can be turned off if you are unprepared or too early in your own development when you approach them. So don't rush a meeting if you're not ready. Number 8, nothing will help you prepare more for real investors than to have warm-up presentations with people who have been there before, especially if they are professional investors. When you have little, if any, investor presentation experience and are raising seed money, especially early seed money, you need someone who is experienced to throw rocks at you. Not literally, of course, but someone who has been there needs to tell you what's wrong and missing. Number 9, particularly if you are raising your first $1 million, you're not ready to put a value on your company yet. Don't be lured by watching Shark Tank and think that's the only way to do it. Don't put a value on your company too early. Give yourself time to actually build value before setting a stock valuation. Number 10, if you don't have one already, get an attorney as well as an accountant who are experienced in security transactions and can prepare the necessary documentation. Having the right documents speaks volumes to your prospective investors and will help you raise the money you need. Number 11, be able to talk the talk about your stock or have someone else do it for you. Another reason to engage professionals in accounting and securities is for the education that they can give you, and sometimes they can help in closing investors. Anything that gives a prospective investor pause, like you fumbling through an explanation, lessens the chance they will make an investment. Number 12, prospective investors need something in hand or at hand. Not presenting a well-thought-out pitch deck will leave you empty-handed. Enthusiasm quickly wanes before investors write a check if they don't have something to review after meeting with you as proof of what they were investing in. Number 13, investors want a demonstration, even if it's just working wireframes. There is all kinds of free and low-cost software and 3D printing tools to build prototypes. People want to see something tangible that you can demonstrate, no matter how crude or ugly. Number 14, people need to believe what you say. Entrepreneurs can do many things right in building their company and still blow it with investors if their numbers are not believable and defensible. And finally, number 15, and my favorite, success in seed investing requires speedy decision making. And without a sweetener, your investment will lack urgency. Seed investing, particularly the early money, is largely driven by emotion, which includes using FOMO, an acronym for fear of missing out. Time is not your friend when it comes to closing one-on-one family, friends, and most MLE investors. Now you may be thinking, holy smokes, I've made a bunch of those mistakes. Well, don't worry. Just stop making them and keep watching the rest of this webinar. Okay, we've talked about things you shouldn't be doing anymore. Now let's dig into the 5 components that you should be doing that will definitely enhance your results. You don't absolutely need to be doing all 5, but if you do, your chances of closing more and larger investments increase dramatically. Here are the 5 key components you want to have in your seed funding strategy. First is making sure the investors you are going after are what I call the right type of investors. Next is an exciting story. At every level of fundraising, investors need to be excited about what you're doing. Then investors need to see that you have done something productive with the money you have raised to date. And investors really need to see what's in it for them. How will they make money? And when are you thinking an exit might occur? And lastly, giving investors a sweetener is so important at the early seed funding stage, particularly your first $1 million. You need them to not only write a check, but write a bigger check now. Now let's start with the right investor targets. You can say anyone who writes you a check is the right investor, but you can't afford to waste time going after investors where there is a low percent to 0% chance of them making an investment. So I'm going to review some low percentage targets first, and then I'll give you several examples of right investor targets for seed funding. As we go through this list of low percentage investor targets, remember this is not absolute and there are always exceptions. But to begin with, just being rich does not make them a good seed investor candidate. It depends on how they got their money and what kind of investments they are involved in today. And the richer they are, the less likely they will be interested in your seed investment. Watch out for people who offer upfront to make introductions if you first give them a piece of your company. They are unlikely to produce a single investment for your company and rarely even a meeting, but they will take your precious equity if you give it to them. Tell them no upfront, but it's okay to make a deal with them to give them some stock if one of their introductions does invest. The moment a prospective investor says they need to run this by their financial advisor, they're not investing. They just don't know how to tell you to your face. A financial advisor and her CPA is there to protect the assets of their clients and will steer them away from high-risk investments like yours. A seed investor needs to be excited to write a check, not play it safe by running it by their advisors. Sounds like a great deal, right? Pay us $2,500 or $3,500 and you'll get to present to our group of angel investors. You're thinking, sweet! I can get in front of a bunch of angels at the same time. And if just one of them invests, it will be worth the money I paid. And you're right. If one of them invests enough, it would be worth the fee. But most angel groups are social clubs, and few companies actually get investments. Now, if you do some searching, you can find lists of venture capitalists who invest in pre-seed to seed funding. But keep in mind, they also look at 1,000 or more deals for every one they invest in. That's what makes them a low percentage investor target. Not zero, but very low. Now let's talk about who are some of the right investor targets. And we begin with family and friends, those that already know you. The people you have history with are the most likely to want to help you if they can, particularly with your earliest seed money. Now, there are some MLE type investors who are experienced in early stage investing and should be at the top of your prospective investor list. They have money, they've done this before, so they know what they're getting into. You just need to convince them yours is a worthwhile investment. These people are also the best to make introductions for you to others like them who will also invest in startups. MLEs whose assets have significantly appreciated, like when real estate is up, or those that made money in crypto and got it out before it crashed, for example. Psychologically, the fact that they have made money with other investments of theirs gives them a sense of higher intelligence and personal confidence in their own judgment. That may not be true, but it does make them highly desirable potential investors. MLEs who are building their wealth almost exclusively through their income have got in that position because they are highly knowledgeable and skilled in their chosen profession. Though they often have little, if any, knowledge or experience in investments, they are looking for places to put the money they are making and can be attracted to the potential windfall from betting on the right startup. Angels usually concentrate in specific industries, so know their focus before approaching. Angels who already have investments in your space can be great at the right time, like when you're ready with proof. However, if you begin to build relationships with the right angels early and keep them informed of your progress, they will be primed to invest when you're ready. It's all about how and when you approach them. Okay, now let's talk about the second key component to raising seed funding, an exciting story. What makes an exciting story? Everything about your business that makes it unique, and especially what you've already accomplished that is bringing your vision to life. Your story is one of the defining factors in what makes an investor write a check. What does your product or service do to solve a real problem? And if you're solving a problem, how much of a problem is it and for how many people? What have you done to prove it solves that problem? If you created a new technological approach that made it possible, put a spotlight on that in your story. People love to believe they are investing in something that may redefine the paradigm because of some innovation the world has never seen before. If you've been able to achieve any of your high-risk items and taken those issues off the table, shine a spotlight on those in your story. The more you have already accomplished, the better. It proves to prospective investors you and your team know what they're doing and can get things done. If you've completed your prototype and have prospective customers already testing and using it, that's major. If you have customers waiting for you to scale and get your product or service to them, that's a huge milestone. Now let's talk about breakthrough achievements. What prospective investors are most interested in is to see momentum. They want to jump on a moving train, or even better, a rocket ship, not one that's still trying to pull away from the station. How are actual users responding to your product or service? If you have beta users who are referring their friends, and those friends are also using your product or service, that's really big. If you gave some early users your product to test and then asked for it back, and they offered to pay you to keep it, that's massive. Of course, every investor would prefer you were already generating revenue. Nothing proves your business like people already paying you anything for your product or service. The more you can demonstrate through results that the future you describe is close at hand, the more likely they are to write a check. If you're in the B2B space, there is nothing that validates your business model like signing an agreement with an established company who wants your product or service, even if it's just a development agreement. Scaling is a process. It doesn't happen overnight. Now, this is where actual revenue is not always necessary to raise substantial amounts of money. Waiting lists of customers who have signed up or put themselves on a list to be able to try your product when it's available demonstrates almost as much as actually generating revenue. Anything you can do to have people put themselves on a waiting list is huge. Now we get to the investor. They are writing checks because of what it means to them. They're not doing it to help you, though some that know you will say they are. They're doing it to make money. And you need to be crystal clear on how they will make money. You have to tie all the things you're trying to accomplish with what it means to their investment and how it will increase in value as a result. What does it mean to their investment value for you to complete your prototype or scale it or sign your first agreement? It's critical to translate your projections to their investment without making any promises and heavily conditioning any statements you make. But you have to put the future in their perspective. You have to get them excited about your future. Will completing your next milestone make you a likely acquisition target? And to who? Will signing a deal with XYZ company potentially lead to them buying your company down the road? This is where convertible notes can be especially valuable as vehicles in the early seed funding stage, particularly your first $1 million, especially with family, friends, and MLE investors. No matter what the future holds, your investor is gaining interest on their investment every month. Even if that increase will convert to stock later, their principal is still growing, which means their investment continues to increase in value. Now we get to the most important of the 5 key elements of raising seed funding, the sweetener. Remember, seed investing is a 90+% emotional decision, and you need to push that emotion with most people. Seed investors need motivation to write checks quickly, while the aura of your presentation and story is still fresh. If not, their life, will get in the way. So you must give them a reason to write that check, today, tomorrow, or in the next few days at the most. Here's an example of an imminent event that includes a deal for those that get in now before the event. The thing about creating an imminent event is that you need to stick to your story and move on. If an imminent event and sweetener doesn't get them to act, they were never going to invest, at least not in your seed round. Now, there are lots of variations of this approach, but this is another example of both an imminent event and a deal. Again, you have to be able to walk away when you make offers like this, but you can also let it slide a day or two. If they call you back on Monday and say they're ready to write you a check now, or if they need time to liquidate other assets, for example, like public stock. Now, this is a great example of a successful approach to ladder up the sweetener to get them to make a bigger investment, which is obviously desired. The bigger the check, the fewer investors you need. You'll be surprised at how many will give you more money to get a better deal. It's like getting in on a sale. And the fact is, you should be okay with a sale that brings in larger investments. For certain individuals, knowing they can have a direct influence on the company and its development can make a huge difference in not only investing, but also how much they will be willing to invest. Now, the third portion of this webinar, the things you must be accomplishing with the seed money you are taking in if you expect to raise bigger rounds of funding in the future. Remember, you must be taking risk off the table in order to climb the valuation staircase. And there are 3 things that you must accomplish with the seed funding that you raise. Proof, and more proof. Investors will want solid evidence, not just that your product or service are being used by others, but that it is a must-have, something they won't give back or do without. Will interviews with those using your product or service reveal it's just okay? Or has it reached the level of can't do without? If your beta testing proved customers love your product or service, what have you accomplished to prove you can scale it? What proof have you developed that customers beyond beta users are waiting for your product or service to become available? Now, if all your beta users love your product or service, what proof do you have that you can now generate revenue? If you have started collecting money from a few users, what proof do you have that your projections of future revenue are valid and reasonable? It's one thing to claim your product or service is a quantum level above what is already available in the market today, but what proof do you have that it is so superior to anything else? A little better is not worth investing in. Have you proven you can recruit A-level professionals that can really help you build an organization and scale? What level of milestones have been achieved with the management and team you have today? How will you be able to defend your position against future competitors? Have you filed patents on your technology, tied up a key supplier? What are you doing that is defensible? Or can you be run over by a better funded competitor who gets to learn from your early efforts and mistakes? And who do you have advising your management and providing corporate governance? In other words, who is providing wisdom to the company leaders and helping them with critical connections that can evolve the organization from a train to a rocket ship? Okay, I've tried to give you some ideas of some things to stop doing, what to start doing, and things to do more of. But I understand it's not easy. Our help to you doesn't have to end with this webinar. For those companies that meet our criteria, and if the founders are coachable, we make ourselves available for weekly mentoring. Now, it starts with a complimentary discovery call where we find out more about you, your company, product, and situation. But please understand, we can't possibly help everyone who wants our help. So there is a screening process that many will not pass after the discovery call. The results we have achieved are possible for you too. It all depends on your level of commitment and how driven and tenacious you are. If you look back on the last 3 months and you think, I'm not where I need to be, now look ahead. How can you be certain the next 3 months will be any different? There's literally no reason why you can't take steps now to ensure the future is a huge improvement over the past. Go ahead and schedule a discovery call if you would like our help. On the call, we'll ask questions about the information you provided and assess your situation, then leave you at the end of the call with a strategy and advice on how to get where you want to be. If it feels like this would be a good fit for both of us after the call, we may offer to mentor you. This is where you can actually become a client of ours to help you achieve your funding goals. For those that are accepted for mentoring, this will change your world. Once you schedule your call, on the next screen there will be a list of questions to answer. This is crucial to one of us getting on a discovery call with you. If you don't fill out the form on the next screen after scheduling, we'll have to cancel your discovery call. We won't waste our time during the call finding out basic information about you and your company. We will come prepared, and you should too. Now, this is about your opportunity to raise the money you need to build your company, or go back to the way that you have been doing it. We know exactly what you are facing and going through, and how to move you forward quickly. Helping entrepreneurs is what we've committed the rest of our careers to doing. If you're not accepted into our mentoring program for whatever reason, then we'll do our very best to point you in the direction of something that will help, okay? It all starts with that phone call. Just click the button in front of you to schedule your call now. All right, everyone. I'm going to go ahead and end the webinar here. We're so grateful to have had this opportunity to share some of the knowledge and experience that we've acquired over decades of raising early seed funding, in the hopes that it may in some way help you in your journey building your company. Thank you again for your time, and feel free to connect with me on LinkedIn if you like, or send me an email. Just please note in your message that you saw this webinar. I would appreciate it. Again, I'm the original Michael Scott, wishing you all the best. Godspeed.